So things like salaries, the services between an employee and the employer, that's disregarded for VAT purposes. It's just outside the scope. A genuine profit share, no VAT. A dividend, just ignored for VAT purposes. Genuine compensation or a payment for damages, again likely to fall out of the scope of VAT. Or a pure disbursement, where you've incurred a cost, where you've paid for a cost on behalf of someone, and you may be able to pass that cost along outside the scope of VAT. But you'd be amazed, all of these categories up here, all it takes is the wrong phrase in a contract, or something misleading on an invoice, and that can turn something that's outside the scope suddenly into the scope. And so we do a lot of work reviewing contracts, invoicing, taking a position on whether monies received by a business are likely to be taxable, or whether it's reasonable to treat them as outside the scope. And also supplies made or treated as made abroad, outside of the Bahamas, they're likely to be outside the scope of Bahamas VAT, but it's possible that they could then be subject to VAT somewhere elsewhere. So, that's something, if you are an international business, you're selling goods and services across the globe, yes, you may get a zero rate in the Bahamas, or it may be outside the scope of Bahamas VAT, but you could still end up having to pay and register, charge VAT maybe at a different rate in a different jurisdiction. Just something to watch out for. Right, so we talked about input tax, we talked about output tax, we talked about the net position. Let's look at VAT recovery in a bit more detail now. So, if a business only makes taxable supplies, so all the income it receives for the sale of goods and services are taxable, so VAT is chargeable either at the standard rate or the zero rate, they can generally recover all VAT incurred on their purchases. That VAT doesn't stick, it shouldn't be a cost, and therefore there shouldn't be a real cash cost to the business. It should be a nil net effect, subject to some restrictions, and we're going to look at those in a bit more detail later on. Although there will be a degree of cost in terms of compliance. But conversely, if a business only made exempt supplies, they're known as an exempt business, yes, they're not charging VAT on their goods and services, but they can't recover input VAT. They can't recover VAT on their costs. That means the VAT does stick, and it becomes a genuine, real cost to that business. So, I had a meeting with a very large bank in London. The cost of VAT to that bank is hundreds of millions of dollars a year. They have the advantage they don't have to charge it on their onward selling price, so VAT is on a reduced margin, but it really adds up. And so for them, transparency is key. For every cost they incur, they really need to understand, has that VAT been charged correctly? Have I got the right evidence? And if I have, and that VAT has been charged correctly, what does it relate to? What part of my business? Because we're about to see, even though there's no recovery if you're fully exempt, most businesses who do have exempt income will also have at least some taxable activity. And that means we need to do an apportionment. And so those businesses are partially exempt. And that means, based on the same logic we've just followed, they can recover all VAT that is directly linked wholly and solely to the making of taxable supplies, goods and services they charge outward tax on, at the standard or zero rate. Where that VAT relates to a cost that is directly attributable to and wholly and solely for the making of an exempt supply, goods and services where VAT hasn't been charged because it's exempt, there's no recovery, that's completely blocked. And that leads a third category, or a third pot of costs. And that's often just referred to as the pot, the residual pot, residual costs. And therefore the business needs to come up with a way of allocating those costs to taxable and exempt supplies. And the general way that's done is called the standard method. And this is, you do a calculation looking at the proportion of taxable income to total income. So you've got your 100% in the taxable pot, you've got 0% in the exempt pot, and then you'll come up with a percentage to recover on everything else, on your overheads, on costs which are used to make both types of supply. So our understanding in the current legislation, there's a de minimis limit. So if you calculate this percentage, and I believe it's 90% or more, you can actually still recover the VAT on that residual. However, for a lot of financial institutions, businesses that are very heavily exempt, that percentage will differ quite significantly. Right, I thought we now start to look at the specifics of the Bahamas VAT. We're going to look at the legislation, the regulations, and the guidance that's been issued. So the main piece of legislation is the Value Added Tax Act 2014, or VATA, as I've heard some people refer it to. And this provides for the imposition and collection of VAT on the supply and importation of goods and services in the Bahamas. We also have regulations, so this provides a bit more of the working regulations around the tax, goes into a bit more detail, adding more definitions, adding a bit more meat to the bone of the actual legislation. We've had guidance on transitional arrangements, what to do with supplies of goods and services that cross the period when there's no VAT now, cross the 1st of January, into the new year when we have VAT. And we've also had a lot of guidance issued. So the Bahamas VAT Guide, and also industry guides as well, looking at key zero-rated and exempt industries. I think it's important to note that this guidance doesn't have force of law. It's merely, in effect, the VAT department's interpretation of the legislation. That could change. It's there to provide guidance. It's to illustrate, illuminate, clarify and explain. But generally a business can't rely on that guidance. And what we've seen in the UK and Europe and across the globe is that even though I think this is a fairly clear piece of legislation, and certainly clearer than a lot of other countries I've worked in, there will likely be some challenge, calls for clarification, there could be lobbying, and there could even be some litigation in terms of clarifying definitions, businesses that maybe don't fall exactly within the wording of the legislation. And that could then influence the interpretation of the legislation by the VAT department, by the government. And therefore, it's possible that this guidance may change, It's currently in draft. So that's another thing to look out for. Always look out for updates. Always look out for notices, business briefs issued by the department. Okay, registration. The key number here is $100,000. But there are two tests. One of them is the historic test. So that means that business, at the end of 12 months, will look back, and if over the last 12 months they've exceeded that VAT registration threshold of $100,000, there's a requirement to be registered. That threshold is breached. But also, there's a future-looking test, which means that any one point, if you look ahead over the next year, and you have a reasonable belief that you consider the value of your taxable supplies will exceed that VAT threshold of $100,000 in the next year, you also have a requirement to register. So, maybe this is a brand new contract, a brand new market, a brand new product. You can't avoid registering and charging VAT to get away for that large contract, within that 12-month period. As soon as you have a reasonable expectation that you're going to go over that registration limit, there's a requirement to register. And you've only got 2 weeks to do it. So this is actually very efficient. In the UK, there's generally 30 days. But, and there's a big but here, the tax authorities in the UK currently take maybe 6-7 weeks to actually process the application, give you a VAT number, and allow you to actually do your VAT accounting. I think it's great here that there's been a 21-day expectation set here by the government that the VAT registration will be processed, approved, and you'll be given a VAT number. So hopefully this is very efficient, and that means within a month from knowing that you've got a requirement to be registered, to then have your number, be in a position to do your VAT accounting, issue your compliance invoices, and then the end of each period, file the return. But even if you're currently below the VAT registration threshold, there is the opportunity to voluntarily register. And I know everyone's thinking, why would I want to register if I don't have to? Well, it may be that you'd be in a better net position. For businesses that incur a lot of VAT on their inputs, this gives them the opportunity to recover that VAT. If a business is in a business-to-business scenario, there's no disadvantage of charging VAT because it's transparent, it's levied on top of all the agreed prices, and as long as that customer is a fully taxable business, there's no cost, just the cash flow cost. We may see that having a VAT number becomes an important thing for a business to have. It's almost like a part of a know your client procedure. It adds a bit of gravitas to the business. We've seen that a lot in Europe. Some businesses will refuse to trade with businesses who don't have a VAT number. So that's something to note. And looking at the guidance, looking at the legislation, this voluntary registration is available for anyone who carries on a business within the Bahamas. They're carrying on or intending to carry on a taxable activity, and that they're likely to be able to recover VAT on their costs. And also, just because they're registering voluntarily, they're still willing and able to keep proper VAT records and able and willing to submit VAT returns. Yeah.
We're going to take a break, but we're going to entertain any questions. Since I have the mic, I'll start with a question. I want to ask Alex about registration. What happens in the case of the mines in some places here may be if you register, and then the next year all of a sudden you're below the threshold, then the next year you register. Just in your experience, how does the tax authority really do that kind of, I guess, that kind of behavior, or that kind of scenario where you registered one year, the next year you're out the next year?
I mean, there's certainly some guidance on this in terms of the kind of period you need to look at your revenues. I mean, certainly what the authorities and businesses won't want to do is to simply deregister, register, deregister, and be like a yo-yo, because that's going to have significant costs to systems, processes, and also is likely to lead to a loss of VAT in terms of leakage of costs, and also maybe difficult commercial discussions with customers and suppliers. I'll look up in the legislation a bit later and we'll fill you in over lunch the exact thresholds that the government sets. In the UK, they normally have a kind of higher threshold to then deregister, because they know businesses that are trading around the threshold limit. They don't want someone just just say at the end of 12 months, actually I want to deregister now, and then 3 months later say, actually I've gone over again, I need to register. So I think in practice, once a business is registered, they'll probably want to remain registered. It will only be really where the customer base tends to be private individuals, so customers who don't have an ability to recover VAT, and therefore charging VAT could put that supplier at a commercial disadvantage. But again, that is offset to some extent by the ability to recover VAT on costs.
Mr. Delaney has a comment.
Yeah.
Kendrick, I just wanted to add a comment to that. My understanding of the current legislation, its interpretation, is that once you're registered, you will remain registered for 24 months or 2 years. So you won't be in and out of being required to file a return. Obviously, your business volumes may fluctuate within the 2-year period, but you remain registered until it's proven that your business level has fallen below 100,000.
Any questions?
Thank you. Sir, my question for you is, in your experience, have you heard about all the countries are presently using also the Caribbean and the Bahamas, we don't have income tax. You mentioned earlier that Dr. Siemens in 1918 came up with this idea because of the fact that they were coming out of a war. But the same thing happened in America in 1913. The then president, he saw fit to take 2 Congress up there to introduce income tax. Now the congressman stood up for their constituents and said, we are going to go through this experiment that we did in England, and we are going to put ourselves under allowing the king to put his hand in our wallet. At that time, he proposed an income tax of 1%. The good congressman saw fit in the United States of America in 1913 to tell the president, absolutely no way. And he then went, because he was the president, and he had a majority of the 2 houses of Congress, and he passed the 16th Amendment. The question is very simple. For us, I need this from you. See, when you rush to get a question, you don't understand the historical background against which it is being asked, then it's a different question. For us, as a Hindus, once we agree to this tax, as is being proposed, what guarantee do we have? Because this is what the Congressman said. how do we guarantee that it won't go from 1% to 35%? And right now, we see that in America, if you're earning over $379,000 a year, your income tax bracket is 35%. So what guarantee do we have? And listening to you doesn't get on the industry, what guarantee do we have that we will stay at 7.5% as a percentage of our growth?
I can answer the bills already passed. I think there is no guarantee. There is no guarantee. That question was asked, well, not in that late, but someone asked a question at the Rotary meeting in terms of whether the rate will increase. And there is some speculation that perhaps, I can't speak for the government, but there's some speculation the rate may not increase before the elections. I can't speak for them. Do we have any more questions? One of the interesting points there, I think people are saying fixed place of a board. I think that's an interesting point. Because we know there's some people who travel all around and are making more than 100,000 in their businesses. A lot of beginners are operating with vehicles or in some other, that they don't have a fixed place. So it's interesting that it actually requires a fixed place business.
The vehicle is a fixed place.
Can you explain more fully how, well, my understanding was that although you're not a VAT registrant or you're not paying VAT, you may be able to recover VAT for inputs to your business. Can you explain that some more? I misunderstood.
So the quick question is, if you are not a VAT registrant, that you can actually claim, what's there? Okay. Business is not valuable, it can be claimed for input tax.
Well, I suppose there are different categories of kind of when you say non-vatable businesses. So, you know, if you're registered because you make taxable supplies, but you don't physically charge VAT because they're zero rated, you would still declare the 0% tax in your VAT return. You'd still recover your input tax. And then, I'm going to go into this in a bit more detail, but the idea is if there's an excess credit, that gets carried forward to the end of the quarter, to the third return, and then the department will then, review that claim for a refund, and hopefully, make an authorising repayment. In the legislation, there is specific legislation that covers, I think, certain exempt bodies, certain government bodies who, may need to make a claim for VAT without actually having taxable activity. But that's quite a niche area. If you just are not registered because you're below the threshold and you don't want to voluntarily register, you don't get the benefits of recovering your input tax. You can't have it both ways.
I'd like to just add to that. I suspect that he was referring to the category of voluntary registrants. You must be known to the VAT department as a registered person in order to be able to claim back any input taxes. So if your business does not in fact meet or exceed the threshold of $100,000, you may still wish to register voluntarily. That will give you the option or the opportunity to actually claim back your input taxes. I suspect that's probably a question you want to get into.
Yeah, I have a question concerning gratuities, restaurants, the VAT you charge on the price of the food, or would that include gratuities?
Okay, shall I go with my kind of view? The way I see this treated in most countries is that if the service charge is freely given and it's a genuine gratuity, it would fall out of the scope of VAT. But then again, there's sometimes a fine line between a freely given gratuity and a kind of service charge which is compulsory. And in Europe, a compulsory service charge could be viewed as taxable with VAT due on. But if it's just something that's freely given and collected on behalf, of the people who are going to enjoy that gratuity, that would fall out of the scope. But it'd be interesting to hear, the view in the Bahamas.
Well, I guess there's a fine line to walk dealing with gratuity. But what Alex has said is generally correct. There is no VAT on gratuity as long as it is in fact a freely given gratuitous payment to the staff who's providing the service. If it somehow becomes a pool that is distributed throughout the business to other staff members, then it's likely that there will be a VAT charge on it.
Okay, question?
When you purchase things, if the final figure you're paying is the inclusive of that, then you have to do what calculation to determine what your input back is so that you can apply that amount as credit. It would be far simpler if you had your purchases, then your back figure, and then the total payment, because you would know immediately how much of the back is your input amount.
Alex, let me take that question with respect to the behavior legislation. All businesses that in fact charge and collect VAT will be required to display on their invoice or their sales receipt the amount of VAT that the consumer has actually paid and was actually collected. That is the transparency that is required. So if you are a consumer, an end consumer, and you receive what is considered to be a VAT receipt, on that receipt will be the amount of VAT that you pay. If you're a business person, on your invoice, your VAT invoice, it will clearly indicate the amount of VAT in order for the business to claim that as an input. Good question.
Bear with me because I'm not. Healthcare in the Bahamas, we have $50 million in services that goes to South Florida in insured healthcare dollars. And I know you mentioned the zero rate in terms of professional services, if I'm not corrected, outside of the country. How does it play in healthcare or with the insurances for those people who receive services in the South Florida industry?
I think that's very specific. I'll let the Bahamas view be taken in a second. I mean, my view would be, in terms of insurance premiums, that is exempt. Generally, when services are exported and the use and benefits of those services is outside of the Bahamas, there shouldn't be VAT on them. Healthcare is carefully defined in the legislation, and it talks about care being provided by Bahamas healthcare professionals, and we can look at that definition a bit later this morning. How that interacts with care being given to, is this patients in Florida?
It's specifically naming patients who choose to go to Florida for health care, which is unique in this area because I don't know in Europe whether people go from France to London for health care, but a good percentage of our population who is insured would receive services in South Florida.
I can't imagine there would be a VAT cost in relation to that. I suppose the key is looking at the income and the flow of monies to treat those individuals, whether that is recorded as exempt income, which is going to have an impact on any recovery on costs, or if that income is just kind of outside the scope because everything happens in the US. I think it's likely to be exempt from most US states' sales and labour taxes. But it'll be interesting to see, if that kind of scenario has actually been looked at by the government, and whether current guidelines and draft, will provide a kind of a reasonable and expected situation in that scenario.
Okay, we're going to take one last question, and then we're going to go into a 10-minute break or so. I'm sure that you have a lot of questions, and Alex will be probably covering some of the material as he goes into the future slides. Okay, so you have the benefit of the last question.
Okay, I have a question. My company sells generators and automatic switches and fuel tanks. You said that is going to be implemented January 1st of next year. So if we still have equipment from December of this year, can you charge back on the products that you still have going into the year?
So these products which you have currently in inventory?
Yeah.
Okay, yeah, so there would still be, depending on the time of supply, when you make those onward supplies, that will likely determine where VAT is due. There are transitional arrangements for where contracts are currently signed and cross that period. We can look at that in a bit more detail a bit later. One of the kind of key themes here is, are you entitled to charge VAT on an existing contract? So, if you have agreed, a price for goods with an existing customer, generally, if a contract is silent on VAT, it's deemed to be inclusive of the tax. So you could have a clever attorney arguing that the price shouldn't increase, but they want a valid VAT invoice so they can take the credit to and get a 7.5% discount on the purchase. But what I would do now is start looking at the typical sale agreements you make on all your kind of sales catalogs, things like that, and start inputting VAT into that. But yeah, you wouldn't have any input to take the credit, but we'll look into the transitional arrangements and see if there's any way you would be exempted from charging VAT in that scenario.
Okay, so we're gonna take a 10-minute break. Don't go anywhere. We'll get more excited. Thank you. At this point, I'd like to reintroduce, it's got to be somebody, man. We're going to reintroduce him. We're going to reintroduce Mr. Pedro Delaney, who is the consultant and member of the VAT Value-Added Tax Unit. He's sitting with us all day, and we just want to thank again Mr. Minister Alcides and the VAT unit. They're sitting to the back. I would advise you to, anything you see with VAT, you want to grab it. They've had some handouts there. And also, I'm going to get the rest of the team, but have their numbers on speed dial. It helps to have their numbers too. So you can just call them in the middle of the night, to go in the morning, get the question about that. Trust me, they have been very responsive. They're very responsive and doing a good job. Okay? We're going to continue and ask Alexander to continue on with his presentation this time. Thank you.
Hi, everyone. Welcome back. Okay, so we just looked at registration requirements. So when a business must register and those time limits, and we've looked at how VAT is recovered and declared and netted off in a return. But how often are these returns submitted? Well, there are thresholds, and those will influence the frequency of a return. So for larger businesses exceeding $5 million per annum, those businesses must submit VAT returns on a monthly basis. between $400,000 and the $5 million threshold quarterly. That's very common globally. And then for businesses with a smaller turnover of under $400,000, the good news is there's only one VAT return every 6 months, a semi-annual return. So I would think most businesses would, fall in that quarterly threshold. So to prevent the need for every single business to submit their returns on the same day, we have this idea of stagger periods. So that this allows the administration to deal with returns on a staggered basis, but it also allows businesses to try and align the reporting and payment dates for VAT with their own business processes and with their own accounting dates. So some businesses may want their financial year end to match their VAT stagger end. Other businesses that may have seasonal fluctuations may want to time their stagger to provide them with a more efficient cash flow basis. But regardless of the stagger or the frequency of return, there are 28 days at the end of after the end of the period for the business to actually pull together the VAT return, pull together the accompanying schedules to support that return, make sure that the business is in possession of valid VAT invoices, so you're entitled to that input tax credit,